Okay, let's get started. Once again, we moved some of the All the Devils Are Here readings back a week, largely so that you can read the book again in the time before the midterm, because about a third of the midterm is going to be on All the Devils Are Here, as a kind of police the reading exercise. As you'll see if you take a look at problem set 6, which is our sample exam, which is now out and which is due a week from now at 11 a.m. on Tuesday, March 8th here, and do write your section times on the front. And as I said, midterm 1 is on March 10th. We'll try to grade it and get it back as quickly as possible so you have an idea of how well you're doing in this course. One more logistics thing, our commercial for the Berkeley Blum Center Friday Political Economy Colloquium. We have Alan Karras and Mark Healy and also Tyler Stovall from the Dean's Office signed up to talk about the value of global history for modern political economy. For those of you who are political economy majors and are wondering why we've structured the major the way we have and should we perhaps change it, we do make you take a lot of history. And the question is why? We make you take rather more history than any other parallel program I know of, except for possibly Harvard Social Studies. We're going to get Alan and Mark Healy from History and Latin American Studies and Tyler Stovall from History in the Dean's Office to come and try to explain to us why this is so. Time 2:10 on Friday, food at 3:10. And last time everyone agreed that the vegetables were wonderful and the cheese was excellent, but they wished there'd been some refined sugar. So we'll see if we can get some refined sugar for Friday. Recapitulations, things you really should know for the midterm. Well, in addition to the economic growth models, in addition to reading the book, All the Devils Are Here, in addition to reviewing the textbooks and thinking that you've gotten the identification-like things we're going to ask nailed down, the one-sentence identifications, you need to be able to use the income-expenditure equation. You need to be able to figure out what the level of real GDP is in an economy if we give you a whole bunch of spending flows. In this case, we have our components of autonomous spending adding up to 8 trillion. And the question is, if those flows of autonomous spending are 8 trillion, then what is real output Y in this economy going to be? They seem to be counting down. And once again, we're all spread out, which worries me. That is, you should by now be able to say, look, with this CY here of 1 and this tax rate of 2, when you look at the denominator, you're going to be taking 1 and subtracting 0.8 from it, which gives you 0.2. Adding 0.2 to it gives you 0.4. The multiplicative inverse of 0.4 is 2.5. And 2.5 times 8 trillion is going to give you 20 trillion, is going to give you E. And if only 28% of you are getting that now, you're going to find that the midterm is going to look very, very long to you. Because being able to do things like this reasonably quickly and accurately is kind of key. And we're going to ask you to do the investment savings version of the equation. That dividing the pieces of autonomous spending into those parts that are determined by monetary policy and financial markets, those parts that are determined by fiscal policy, and those parts of it are determined by other stuff. This is another version of the same circular flow of aggregate demand that we see in the income expenditure equation. This is often a more useful one if you're thinking about economic policy in any of its forms. And here the first part of this equation is to ask you to figure out what the multiplier is, what the multiplicative inverse of these terms in the denominator are. And indeed, if CY is 0.8 and if T is a 0.25, then 1 minus 0.8 times 0.75 will give you 0.6, 1 minus 0.6 will give you 0.4, plus 0.1 will give you 0.5. The multiplicative inverse of 0.5 is going to be 2. We're getting there. We're at 47%. But once again, the midterm is going to be long if these calculations aren't second nature exactly, but if these calculations aren't things you're comfortable doing. Because we're then going to ask you to take that multiplier and apply it to what happens when something goes on in financial markets, when something happens in monetary policy, or when something happens to the government's fiscal policy. How is that going to affect the level of real production in the economy as a whole? And in order to do that, you've got to remember the multiplier from last slide, and you've also got to be able to figure out what's going on in the numerator of this equation as well. So let's go through it. We have real interest rates rising by 5 percentage points, smaller than the spike in junk bond interest rates that we saw in the 2008 collapse of the U.S. and the world economy, but still very sizable. How big an effect is this going to have on real GDP? Well, we have an isobar, a sensitivity of investment to the real interest rate of 10, sensitivity of exports to the real exchange rate of 0.5, but a sensitivity of the real exchange rate to interest rates of 10. Add these two terms together, and that gives you a sensitivity of autonomous spending to the interest rate of 15. Multiply 15 by 0.05, by 5%, and you get 0.75. Multiply 0.75 by your multiplier coefficient of 2, and you get 1.5 trillion. The interest rate's going up, which means that real income is going down. So the correct answer here is going to be B. And once again, things are going to go much more easily for you on the midterm if you can nail these types of questions and nail them successfully relatively quickly. Last thing, we want you to know not just the income expenditure, but the investment savings version of this aggregate demand model, precisely because right now we're in a configuration where truly extraordinary things happen to the interest rates at which interest-sensitive businesses that want to expand their capacity or even to continue their operations find that they have to borrow. We are right now in our 9% unemployment fix because of this enormous spike in long-term risky real interest rates, because the Federal Reserve's attempts to keep it from happening by lowering safe short-term nominal interest rates to 0 wasn't nearly a big enough policy move to offset the things that were going on in financial markets, and you had this panicked flight by investors and banks out of all securities perceived to be risky into securities perceived to be safe. And even though now, as best we can tell, the terms at which businesses can borrow are back, if not to normal, at least not to some terribly, terribly bad level, the economy is still in a substantial fix. And one question is why. We're going to review that in a little while. One last thing that we hope you remember. that when you look at the investment savings version of our aggregate demand equation, you can see where fiscal policy comes in, where changes in government purchases come in. And you can affect tax policy too by changing the tax rate, but I don't think we really have time to go into that. We'll stick with changes in government spending as the principal modality of fiscal policy, which they are, boosting government purchases in an attempt to get unemployment down to normal levels and production up to where it should be. Then we have all the things that go on in financial markets and with monetary policy. The first of which is the short-term safe nominal interest rate, this thing that the Federal Reserve controls via its open market operations, that it can nail, and that it does nail when it wants to. Then on top of that, you have the term premium. The fact that the Federal Reserve controls short-term interest rates and long-term interest rates are in large part a guess as to what the Federal Reserve is going to do in the future. When businesses, investors, and savers expect the Federal Reserve to rapidly raise short-term interest rates in the future, this term premium is going to be large. When they expect its policies to persist and to keep interest rates low for a long time, this term is going to be small. This is an expectational variable, the kind of expectation of the persistence of the Federal Reserve's current policy. The Federal Reserve can affect this through job owning, through talking, through communications, and also through establishing a track record of following through on its policies. Otherwise, this is very hard to move. You have expected inflation, which enters into this determination of total spending with a minus sign, because if nominal interest rates, holding nominal interest rates fixed, if expected inflation is higher, businesses are going to say, hey, we can borrow and then pay back our borrowing cheaply in depreciated dollars. We should borrow a lot and invest a lot. Want to get an economy out of a really deep downturn, out of a Great Depression, if you can create some expected inflation. That's a wonderful way to do that. Federal Reserve doesn't want to create expected inflation for reasons we'll go into after the midterm right now. So this as a tool of policy is essentially off the table. So you're left with in financial markets and the Federal Reserve, normal open market operations, which are now tapped out, claims by the Federal Reserve it's going to continue low interest rate, easy money policies for a long time to come, which are of limited credibility, and it's too late for the Federal Reserve to change its credibility. And then there's the risk premium. And the risk premium here is not as big as it used to be, but it's still pretty big. And the risk premium is affected by two things. First, by how risk-averse investors and savers are, combined with how much risk they think is out there in the system. Right now, they still think there's a lot of risk out there in the system, and they are risk-averse. And the second thing is how much risk they have to bear. How much of the financial risks in the economy has the Federal Reserve and the Treasury taken onto their own backs by guaranteeing debts and by buying up risky assets themselves. The Federal Reserve and the Treasury can affect this term by offering loan guarantees and by buying up risky assets. The problem over the past 2.5 years has been that this has been a politically difficult thing to do and an expensive thing to do, and hence the Federal Reserve and the Treasury have not done as much of it as I would have thought. And I think that's landed us in a situation in which our economy is in significant trouble and is going to stay in significant trouble for quite a while to come. And in order to explain that, I'm going to want to make a relatively minor digression and detour into something called Oken's Law after the chairman of Lyndon Johnson's Council of Economic Advisors, Arthur Oken. What Arthur Oken noticed back in the 1960s was that there seemed to be a fairly stable and regular relationship between the unemployment rate and the level of production. Here, for the years for the 2000s, are what the relationship between unemployment and production is. That is, when production is growing at more than 2.6% per year, the unemployment rate's likely to fall. When production is growing at less than 2.6% per year, the unemployment rate's likely to rise. This 2.6% per year growth rate, that Arthur Oken called the growth rate of potential GDP. That's the growth rate of the economy's productive potential, how fast the economy can grow without putting either more or less pressure on the labor market to find more jobs or more workers. And then this thing has a nice steady slope, a slope of about a half. For each 1 percentage point that growth over a year falls short of 2.6%, you'll see the unemployment rate rise by half a percentage point. For each 1 percentage point by which growth in a year exceeds 2.6%, you'll find the unemployment rate going down by half a percent. Given that right now we're expecting growth to be about 4% in 2011, we'll take 4%, subtract 2.6% for potential growth from it, you get 1.4%. Divide 1.4% by 2, and you get 0.7%. Take the 9.4 percentage points of unemployment in December 2010, subtract 0.7 percentage points from them, and you get a predicted unemployment rate as of the end of 2011 of 8.7%. And project that growth rate forth for another year, and you get a projected unemployment rate of 8% for the end of Barack Obama's first term, which would give him the worst unemployment record of any presidential term since the Great Depression itself. A somewhat puzzling thing, given that back in October 2008, Larry Summers was writing op-eds for Barack Obama about how the important thing is not to do too little to fight this gathering recession and not to let it hang on. Now, why is this slope 0.5? Why is the slope half? Why is it when GDP goes down by 1%, unemployment rises by only half a percentage point? You expect that if GDP goes down by 1 percentage point, while you're making 1% fewer less stuff, you should need 1% less workers. In fact, maybe you should need even fewer workers than that. Maybe you should fire more than 1% of your workers if production falls by 1%, because your capital and natural resources are still there and they're still being productive. Why is it a half rather than 1 or something bigger than 1? Well, there are, say, 4 reasons. The first is simply discourage workers. This is the unemployment rate. If someone is fired and then drops out of the labor force because they don't think they can get another job, they don't show up in the unemployment rate at all. And so businesses are actually firing not 0.5% of their workers when production goes down by 1%. They're actually firing about 0.7% of workers for each 1% that production goes down. But a bunch of those are going straight out of the labor force. Second is hours. A bunch of firms respond to slack demand not by firing workers, but by cutting back on the hours that people work. Third is there is some pro-cyclical productivity in there. There are a bunch of places in the economy where to boost production by 1% requires less than half a percentage point increase in your number of workers, and when you try to cut back production, you find you really can't cut back workers proportionately and still make the system go. But fourth and last, we used to have something called labor hoarding, by which businesses would say, hey, we like our employees a lot. They're skilled, they have lots of training. If they were to wander off, we couldn't really replace them very well. As long as we're confident that this current economic downturn is going to be relatively short, we're going to want to keep these workers around. we're going to still want to keep them on the payroll. Even if we have nothing for them to do, we can put them to work painting the factory or doing something else. And that also tended to make this Okun's law line significantly flatter than you would think it would be from just the basic engineering of production. And hence our problem in 2009. Right, that we have this nice Okun's law relationship with a bunch of pluses and minuses above it. The year 2008 was not at all exceptional. The year 2009 goes absolutely boing. Right? The unemployment rate rises by an extra 1.7 percentage points relative to what we would have expected to rise given what happened to production. If we simply looked at production and at the normal Okun's law relationship, we'd have expected our unemployment rate at the end of 2009 to be 8.3% nationwide. Instead, it was way up there at 10%. And that extra 1.7%, did not come back in 2010. We hope it'll come back in 2011, that we'll see better employment performance than output performance would warrant, but we're not at all sure that we will. So this Okun's law framework, by which there is this nice stable relationship between production and employment, the unemployment rate seems to have broken down. That businesses seem to have taken advantage of 2009 to fire a lot more workers than they would have normally. Yeah? All the way back to 1945. It's remarkably stable. Before 1945, things are different because the Great Depression is so large and because America is substantially an agrarian economy. What Christy Romer and company said when they were working for Obama and had to write about this? Well, they said that though the fit of Okun's law is usually good, the relationship has broken down somewhat. I tend not to think that 2.5 million extra unemployed is a somewhat. And they went on to say that it's not because anything unusual is happening to the labor force. What's happening is because businesses are taking advantage of the recession to try to make workers work harder and improve productivity. Instead of acting in a labor hoarding vein, by which you say the most important thing in a recession is to keep the workers we'll like to have for the next boom around in the future, so that they're still there when demand recovers and we don't have to worry so much about increasing productivity during the recession. Businesses during the recession seem to have decided this time that their first priority was to cut labor costs and improve the efficiency of their operations as fast as possible, which is not something that Arthur Okun had taken into account and not something that we saw in the U.S. economy in the 50s and the 60s and the 1970s. But we did see this a little bit. If we had been looking very carefully during the 2001-2003 economic downturn, we have seen, say, you take the scatter of hours growth, of growth in total hours worked, and of growth in total output along the vertical axis, and you just look at where the economy runs from 1960 to 2003, you get this large cloud of points. And then in 2002 and 2003, you find yourself out at the extreme of this cloud, leaving the cloud, breaking new ground. That even though output is growing at 2% per year in the 9 quarters ending at the end of 2003, it's still the case that businesses had been cutting hours at a pace of 2% per year over those previous 9 quarters. So we've seen signs of this before. Not nearly as large a phenomenon as we see now. Total effect on the unemployment rate, something like, a little less than half a percentage point by the time you take 2001, 2002, and 2003 together. But still some definite signs of something happening, somewhat analogous to what happened in 2009, albeit spread out. Now, 2 researchers at the Federal Reserve Bank of New York, Erica Grosjean and Simon Potter, started looking at this in 2003, saying something odd is happening to Okun's law. We don't see the usual cyclical pattern that we're used to seeing in America. And they then went back and looked in more detail at the data from 1991 and 1992, from the last recession before 2002 and 2003, and thought, once again, there's something odd going on here. The emergence of a new kind of recovery, one driven mostly by productivity increases rather than payroll gains, signs that what's going on in the business cycle in the economic downturn is not just a cyclical reduction in employment that then will be reversed when the recovery comes, but instead some kind of structural change that's transforming firms, industries, and economies. And they began to wonder whether there was, quote, a preponderance of structural adjustments during the most recent recession, and pointing out that job losses that stem from structural changes are permanent, and hence that we'd expect a long lag before employment rebounded, after a downturn whose principal impulse was some kind of structural shift, rather than some kind of normal cyclical downturn. And so they took a look at what happened to industries in the 1980s and the early 2000s recession. And what they found in the 1980s recession is that those businesses that lost jobs during the recession, those businesses that are on the left half of the graph, are businesses that gained jobs during the recovery. With primary metals and general building contractors being kind of way up there, they lose a lot of jobs during the recession. They gain a lot of jobs during the recovery. Why do they do this? Well, because of the causes of the 1980s recession. You see that the late 1970s were a period of many oil shocks, rising inflationary spirals, the inflation rate crossing 10% per year, the Federal Reserve going increasingly nervous because people were expecting not just that last year's inflation would continue, but were expecting that inflation was going to rise. This seemed to them to be deranging the ability of the price system to do its job, because when prices are rising at 10% per year, practically all the ideas you have in the back of your head about how much things should cost are really no longer valid. And so people become lousy comparison shoppers, both at the consumer and at the business level. And a market economy can only work well if people are doing well as comparison shoppers. Therefore, in 1979, when Paul Volcker took over the Fed as its chairman, he said that we are going to raise interest rates as high as we need to in order to reduce inflation down to normal levels, that we simply won't look at what we're doing to employment for a while. So the Federal Reserve raises interest rates to previously unseen levels during the early 1980s, and the result is that capital becomes extremely expensive for businesses to get. And what are the businesses that depend most on being able to access capital at reasonable terms? Well, the first is housing, right? Apartment buildings, general construction as well. Because when you're building a building, you're building something that's going to last for 50 years. And so if the interest rate is high, well, then the value of that building 50 years out is going to be absolutely negligible. And so higher interest rates mean the